merge that transitions the network's proof-of-work consensus mechanism to proof-of-stake is happening next month. The Bellatrix upgrade, which begins the final countdown, is set to activate on September 6th, and the merge itself will be completed at some point between September 10th to the 20th. Joining us now to discuss is Lucas Nuzzi. He's the head of research and development at Coinmetrics. All right, great to have you on the show with us, Lucas. So, explain in very simple terms what the merge is and the transition from proof of work to proof of stake. What does it mean for our audience who are discovering this for the first time?
Absolutely, and thank you for having me, Christine. The merge is a big moment in the history of Ethereum. They've been researching this new consensus mechanism called proof of stake even before the project launched, and the merge will mark the moment where they will transition to mining to a consensus algorithm that's very similar to Bitcoin into a new consensus algorithm that uses capital as opposed to mining power, hash rates, to validate blocks. And in that report, we wanted to cover everything really that entails, that has pretty wide economic implications for the Ethereum network, for the participants that are actually producing blocks in that network. And we attempted to cover not only the mechanics of how the merge will happen, how Ethereum as it currently exists will merge with this existing network called the Beacon Chain, which was launched in December of 2020. As well as the economics around it. There's a lot that changes as these two networks become one.
Well, maybe you can go into the economic impact as well as the environmental impact, which has gotten a lot of attention pulled toward it.
Yeah, absolutely. So right now, the resources that are being consumed by the Ethereum network are equivalent to nation states. It uses mining as Bitcoin to produce blocks in that network, and as a result, it is very energy intensive. Proof of stake changes that because instead of having to post up hash rates and attempt to solve a puzzle, what you're effectively doing is posting up capital, and if you misbehave, you lose that capital. There's a dynamic called slashing that is in proof of stake. And it's something that changes because instead of receiving mining rewards, you start receiving staking rewards. And these staking rewards are proportionate to how much capital you have, how much you're putting in, and how well you're behaving, how much you're getting rewards from
who are these stakers?
How much you're misbehaving potentially.
Who are these stakers? What are the mechanics behind it? And does it change anything regulatory-wise?
Yeah, that's an interesting question. Right now, mining in Ethereum is done via pools, just like Bitcoin. You have various pools around the world that aggregates the individual miners and make sure that their work is synchronized. That would change drastically after the merge, where instead of having 8 mining pools controlling the majority of block production, what you have is actually thousands, potentially dozens of thousands of validators actually producing blocks. So there is a big change when it comes to who's actually receiving new ETH via inflation, effectively. And there's going to be more security as a result of that, more decentralization as a result of that, because instead of having 8 individual mining pools producing blocks, now you have thousands of validators that are more on the retail side, folks that are running nodes at home. Because proof of stake is less energy intensive, the barriers for entries are substantially lower. So you can even do it using a regular computer, although it's recommended that you use a server, because there is this dynamic of if your computer crashes, you will lose some money as a result of that.
Well, Lucas, one of the primary, benefits of proof of work was the security that it lent. So does this compromise on security in the sense that, all that energy is being expended for the security of the network so that it can't be overridden, there can't be a 51% attack very easily. So does this merge compromise on that security at all? And I saw from your report there are these new questions about the potential centralizing forces of staking pools and staking services.
Yeah, absolutely. So there is a big question when it comes to proof of stake that whether or not there are things that we don't know about the mechanics of proof of stake, especially as it relates to security. So there's a lot there that we just simply don't know. Just like when Bitcoin launched in proof of work, Satoshi didn't really think about this creation of mining pools because smaller miners couldn't really produce blocks given that the network was growing. The same dynamic is actually happening preemptively in proof of stake, where there are staking providers that accept deposits from users and stake that on their behalf. Just like mining, staking can be a very energy intensive activity because you might need various servers to make sure that you don't get slashed. So there are a lot of dynamics that proof of stake introduces that are unknown. What we're seeing now is that there is quite a bit of demand for yield, and a lot of individual investors see proof of stake as a way for them to gain additional yield on their Ether. And one potentially dangerous dynamic of proof of stake is the creation of these staking derivatives. Lido was a big theme in Q1, Q2 of this year. It's staking as a service provider, which enables this new dynamic called liquid staking, which enables you to not only stake, but you're also issuing a derivative on the basis of that stake, and that derivative can be treated as ETH. And right now, that service is so popular that over a third of the validators in the proof of stake version of the network that exists today, the Beacon chain, are controlled by Lido. And in proof of stake, the dynamics for security are different. In proof of work, you have that 50% threshold where anyone that has over 50% can take over the network. With proof of stake, that's actually a third. That critical threshold is a third. And we're already seeing that Lido is reaching that threshold. And there's a big debate on whether or not this is going to be a dynamic that's will continue to grow over the next year or so.
So what are, I mean, that's a risk. So can you talk about some of the risks of this merge and this new proof of stake model?
Yeah, there are several risks associated with centralization, right? The biggest concern is that this is going to be a very self-serving dynamic where things like miner or maximum extractable value, which is this additional revenue that miners achieve via front-running transactions and doing various different strategies, will exacerbate as a result of decentralization. It is already a big theme in Ethereum mining right now. Miners supplement their income quite drastically via these new strategies of effectively front-running users and performing arbitrage trades on behalf of highly sophisticated traders. That dynamic will likely also exist in proof of stake, but at 1/3 of the network, Lido can play an even bigger role in doing so. That has entailed really several set of conversations around who gets to produce blocks, who gets to aggregate the transactions that are going to be within a block, and potentially separating the entities that are building the block and sequencing these transactions from the entities that are actually validating it to basically prevent some of these unwanted circumstances. Mm-hmm. Ultimately, there's a lot of unknowns really post merge,
uncharted territory,
and a lot of economics that will change. Absolutely.
So I also want to talk about the environmental impact, because proof of work networks like Bitcoin have gotten a lot of negative attention because of the energy consumption that the network consumes, which they argue is not much different from, say, the Amazon, Googles of the world. Nevertheless, how does this shift from proof of work to proof of stake in Ethereum impact energy consumption? How much does that bring that down?
It has a pretty big impact because right now the dynamics of punishing users is really by a capital move, basically just slashing individuals and making sure that they lose funds effectively if they misbehave. In proof of work, that is a voluntary process. You mine preemptively, and if you're successful, you get to mine a block and include that block in the network. So the dynamics and the nature of the activity for both is very, very different. In terms of impact, it's hard to measure. It's very difficult to measure the electricity consumption of proof of stake protocols because it's not as transparent as proof of work, right? You can't really look at, in proof of work networks, you have a parameter called difficulty, which you can see how difficult it is to mine a network, and all of the data providers extrapolate the actual cost of mining by looking at this figure, amongst various other figures. In proof of stake, there's also a lot of compute that is being allocated to it. There's a new big unknown, which is redundancy, that's related to it. So if you're, for example, running a validator and you're controlling, hundreds of thousands of ETH, it's maybe in your best interest not to run just one server. Maybe you're going to run 10, so that if one goes down, it's not a single point of failure for your staking, right? So the cost of that redundancy is very difficult to measure. Mm-hmm. But I would caution just jumping into this conclusion that we see frequently, that it is fully a green technology. There's a big cost when it comes to redundancy that we just don't know.
I also see you have a chart on daily net ETH issuance, proof of work versus proof of stake. So I'm wondering, what impact does this merge have on issuance and price of ETH?
Yeah, it turns out it has a really big impact. And I believe we're the first ones to actually model this out using actual on-chain data from the previous year. So what we did here is look at Ethereum's issuance, basically the ETH that is issued relative to the ETH that's getting burnt. Post EIP 1559 on Ethereum, it's a new fee dynamic. A lot of Ethereum gets burnt, and the inflation rate of Ethereum is really a function of how much is being issued versus how much is being burnt as a result of transaction fees. And up top, you see this blue line, which represents the actual proof of work dynamics. And over the course of 2021, there were a few occasions where it actually became deflationary. Ethereum as a protocol became deflationary. We see that if we apply that same dynamic to proof of stake Ethereum and assume that the same level of activity is going to happen that we saw in 2021 in proof of stake Ethereum, it is mostly deflationary as a system. And that's because of the dynamics of issuance. Less ETH is getting issued and essentially printed off thin air. And that has a big implication when it comes to Ethereum's effectively, its inflation rates. Right now it sits at about 4% annually. After the merge, after this proof of stake migration. If the same dynamics and usage continue to exist, it will likely be deflationary as a system, which has some really big implications, especially for platforms that have monetary flexibility, like Ethereum, like most proof of stake protocols that can change really the monetary policy as a result of the community.